Hello everyone, in this video we'll be beginning with the chapter number 34 of CMT level 2 perspectives in active and passive money management. So in this chapter we'll be seeing what are the differences between active investment and what is the difference between passive investment and which one is better or which one has what advantages does each of them have. So that's what we're gonna basically see. So we're also going to see what is alpha and what is beta and what is the efficient market hypothesis and so on. So let's begin with the chapter. Equity investing can be divided into two main categories. So we have passive investment as well as active investments. Now, what are passive investors? Passive means something which is like a side income thing. It is not an income which we are generating actively, or this is not something which is a primary source of income, or this is not something which is regular in nature. Okay. So when we say active investment, we mean that actively we are getting money from it, right? So passive is obviously the opposite of active. So, passive investors buy and hold stocks for the long term. They construct portfolios or choose investment vehicles that minimize costs, including research costs, trading costs, administrative costs, performance fees, and taxes on realized gains. The most popular types of passive investment vehicles include index mutual funds and ETFs, right? So, now these are the things which basically imitate the particular stock index, right? So, that's why. Active investors, however, seek to outperform the indexes by identifying individual stocks to buy and sell. Because they trade more often, active investors turn their portfolios over more time. So, obviously, when you are turning your portfolio very frequently and you are changing the portfolio or you're buying and selling more frequently, in that case, you have to also pay more commissions and more brokerage, right? So, those kind of costs are also more when you are indulging in active investing, but at the same time both of them have their own sort of advantages and their own sort of disadvantages. Now let's talk about this. Give me a second. Okay, so let's talk about relative versus absolute return investing. Active investment can be further divided into two main categories. Okay, relative return vehicles. Okay, so what do you understand by relative? Relative means that in comparison with some particular benchmark index. All right, so relative returns are always in comparison or in relation with something else. For example, these active investors basically want to beat the returns of what the index would give. Like for example, S&P 500 or Nifty 50 index or so on. So whichever benchmark index you are talking about. Most equity portfolios, including equity mutual funds and student investment funds, are relative return vehicles where the fund's performance is evaluated relatively to a benchmark. Okay, so that is what is known as a relative return. Now, what is absolute return? Absolute returns basically seek to deliver returns that are less risky but usually lower than the benchmark index. So when you talk about absolute return, what happens is that they do give a return, but the risk here is extremely low. So they give you it is less risky than the indexes, but it gives you a stable return for sure. So now we talked about active investing. Active investing can be divided into two sorts of categories. The first thing is relative return. The second thing is absolute return. Okay, these are the two parts of active investing. Now, relative return was in relation with the benchmark index, and absolute return is when you have less risk as compared to the indexes. Many equity hedge funds are absolute return vehicles. Examples include long short funds that make more positive bets and negative bets. You may notice that the terms active and passive are to some degree loaded words. In many cultures, being passive is usually considered less desirable than being active. However, that's not true. Some people are meant to be active investors, some people are meant to be passive investors. So you cannot say one is better than the other. So buy and hold is also something which is very prevalent, right? Buying and holding for long term. So there are many people who are really good long term investors, but they're really bad short term traders. But there are traders who are really good at, let's say, scalping, but they're really bad if they hold a stock for more than a day. So it really, depends. Now let's talk about alpha and beta. You might have heard about these two terms in the finance, in all sorts of finance topics, right? So let's talk about alpha. Now alpha is basically the excess returns earned by relative return investors, either above or below the market index. Okay, so whatever benchmark index you are comparing your performance with, so if the portfolio outperforms the benchmark index, then you can say that the percentage would basically be the positive alpha. Now if the portfolio underperforms the benchmark index, then we'll say that it has a negative alpha. So now that is what is known as alpha over here. I hope you understood what alpha is. And then we have beta. Beta is a measure of risk that you can apply to an individual stock or portfolio. So beta is basically the risk. Okay, it talks about the volatility. So whenever you talk about the word beta, the first thing that should come to your mind is volatility, right? So if some stock has a high beta, that means that it is more volatile. If some stock has a low beta, that means it is less volatile, right? So which means that if the benchmark index shows a big movement, then in that case what happens is that the particular stock will also give a big move. So when the stock is doing good, the when the stock is doing good, in that case what happens is that when the benchmark is doing good, the stock does really well. And whenever the benchmark is doing bad, in that case the stock does really bad as well, right? So high risk but lower is, so you need to understand that if there's a big positive movement, then you are going to gain a lot. But if there is a big negative movement, then you are obviously even going to lose a lot. So it is quite risky. That is what you need to keep in mind. Okay, so I hope you understood what alpha is. Alpha is the relative return as with compared to comparing to the benchmark index, and beta basically talks about the volatility. Moving on, so we've done what alpha and beta are. Okay, now let's talk about the top-down fundamental analysis. We're not talking about technical analysis here. We are talking about how does the fundamental analysis take place when you do it on a top-down basis. So now let's talk about that. So obviously, we are going to start with the overall economy, and then we'll come down to particular sectors, and then we will come and shortlist our stocks. So that's what is basically the fundamental analysis. So what really happens is that the analysts divide the stock market into 10 sectors. Okay. When an actively managed portfolio allocates funds by sector in a way that differs from their current market weights, we will say that the portfolio manager is employing sector overweights and underweights. So they basically rank the particular sectors and they see which sector is performing well in which particular time period and which is not, and so on. The decision to buy a stock and hold it or conviction in the security. Okay, so basically they basically give a particular weightage to the particular sector and the particular stock, and then they take a decision to whether they want to buy it or they want to not buy it. So the first thing is economic analysis determines the stage of the business cycle. So when you're doing the economic analysis, you know that which particular business cycle is the market currently in, or the is the economy currently in. And then we have business cycle stage determines sector under and overweight. So you know that according to the particular business cycle you are at, so you know that during that time, is the sector going to perform well or is the sector not going to perform well, you will know. And so obviously before getting to know this, the first thing you need to know is which particular business cycle are we in currently. And then fundamental analysis determines active weights of individual stocks within each sector. When you are basically shortlisted, when you're done with the shortlisting of these sectors, then you go into the sector and you see which particular stock is outperforming inside that particular sector. Performance attribution analysis identifies why a portfolio underperformed its benchmark. So, obviously, you can know why a particular portfolio has underperformed its benchmark and so on. So, when you do the top down analysis and then you have shortlisted the particular stocks and then you give them particular portfolio weight. So, whichever stocks have the highest weights, that can basically give you a very high conviction and medium conviction and low conviction. So, obviously, you would want to allocate your funds in the high conviction stocks. So, that is one thing. Active investors therefore allocate portfolio wealth among stocks differently than the stock market determined weights. The active investors weighting scheme will be called as the active portfolio weights. Depending on the investment style and depending on the time frame or the time period you are choosing to invest, according to that, obviously, naturally, your criteria also change. So why do stocks with solid fundamentals outperform over long horizons? So you need to know that technical analysis is extremely good when it comes to short term, but in long term you need to have some sort of good fundamentals if you want to hold on to a stock. And even if you historically do the analysis, you would see that stocks which had strong fundamentals, they have always outperformed as compared to their peers. So why does that happen? Because you need to know that stocks with steadily growing revenues, profits, free cash flows, and dividends, stocks that achieve growth by making prudent capital investments, companies with strong competitive positions, and so on. So, these kind of things, when a particular stock has, then that will innately basically tell us that the stock is going to perform well, right? So, what did we think about volatility, or what did we talk about beta, right? Beta basically spoke about the volatility, right? So, you need to basically also keep in mind that, but do we want only, don't we only want to avoid downside volatility? That's not, see, while I understand your question, right, like you can just assume that if you have high violent volatile moves towards the upside, it's good for you. You just don't want a volatile drawdown, right? But again, no, that's not how it happens, right? Because corrections do happen in the markets, and you can sometimes have like a really big sort of a drawdown, right? So that is one thing. The second quarter of the year is an excellent period to study how the stock market works. Research shows that the stock market tends to earn much of its total annual return early in the calendar year. After the first quarter, however, an adage hold that investors can sell in May and go away. Okay, so usually it's a researched fact that during the first or the second quarter only, the markets give the highest sort of returns, and by May people actually sell off their stuff. Okay, so that is one thing which is again said. You can read Bristol Myers if you want to, and so on. Okay, now let's talk about the record of professional money managers. We reduced fundamental analysis to a multi-step process that sounded very easy, right? It looked like it was just a recipe which can be easily followed, but fundamental analysis is really not that easy or that straightforward or that simple in nature. It has like a lot of work which we have to do, and it has like quite some tweaks which you need to make according to the particular situation you are in. Most research into active money management concludes that the majority of the managers underperform their benchmarks. They earn negative alphas. So, this is what is usually said by especially active investors. While I do not promote the idea that passive investing is better than active investing, I do believe that active is a great source of income if you know what you're doing and if you're managing your risk properly. But this is a research which has been done, right? The prevalence of negative alphas among mutual funds is well documented. More recently, S&P versus active funds scorecard reported that over the period of 2004 to 8, 63% of large cap mutual funds, 74% mid cap, and 68% of small cap underperformed their benchmarks. Among international mutual funds, underperformance ranged between 60 to 90. If those results aren't bad enough, S&P reported, okay, so they've just basically given reports where these particular mutual funds have performed really bad as compared to their benchmark index. Their benchmark can be, let's say, the S&P 500 only. Okay. The performance of investment managers in an absolute return or hedge fund space is similarly disappointing. Malkiel and Saha conclude that the hedge fund returns are lower than commonly supposed. Okay. Now let's talk about Mark Halbert. Mark Halbert is again well known for publishing the Halbert Financial Digest. It is a what do you say, it is a newsletter, okay, and that basically talks about how the mutual fund managers are doing and how they are basically interested in which particular sector and so on. Halbert's survey shows that investment manager sentiment is a contrarian indicator. So what does that investment manager sentiment mean? It means that it basically talks about whether the particular investment managers or the fund managers, hedge fund managers, are optimistic or pessimistic in nature. Now, that is one thing he thought. After accounting for fees, the vast majority of active mutual funds had negative returns. But these authors also conclude that the proportion of zero alpha mutual funds is higher than previously thought. They can find 75% of the funds earn zero alphas, implying that the pros earn just enough to cover their fees and other costs. Less than 1% of the funds delivered positive alpha. So that's the kind of research which they have done. Now, yes, we have seen how the mutual fund managers or the hedge funds have not performed well, even as compared to their benchmark index, right? So, why, in the first place, why do these active managers perform not well, or why do they underperform? So, the research reviewed in the previous section convincingly concludes that the aggregate active managers underperform, and they do that, okay? So, these results were not covered with the purpose of picking the pros, just the opposite. As the key mission of this book is to teach you to conduct your own stock research effectively and professionally, it is necessary to confront the track record of the pros to illustrate the challenging and competitive management. We need to understand why such a group of intelligent, competitive, and well-trained people are not showing good results. So it's not to demotivate you and to tell you that you need not do short-term trading or so on. In fact, the reason why we are discussing all these researches is because so that you know that these are the kind of mistakes which people make and you can avoid that when you are doing your own practice. Okay. Okay, we'll start by taking a closer look at the step 3 of the top down process, conducting fundamental analysis to determine which stocks to under and overweight the relative to the weights of the overall market. After we determine the financial health and stability of a company, so how do you determine the financial health and stability? It's by looking at their cash flow, it's looking at their um, ratios, and so on. We will so getting to know about what the financial health of the company is and how stable the company really is. So we are going to do the valuation analysis to determine if a country company stock is trading um, above or below what we call its intrinsic value. So intrinsic value means what is its intrinsic value, right? So a stock's intrinsic value equals today's value of all the free cash flows the company is expected to generate over its remaining lifestyle, right? Intrinsic value is the true value of the company, and it is its basically its free cash flows that it is expected to generate in its lifetime. Estimating intrinsic value is as much a science as an art, as it involves forecasting the company's future revenues, expenses, and variety of income statement and balance sheet items. This step of fundamental analysis process involves a logical inconsistency or paradox that only the best analysts confront. The paradox occurs whenever an analyst concludes that a stock is undervalued or overvalued. So, notice that the market's mistakes are a possibility that we must allow if we are going to be active investors. If we believe that the market price is correct 100% of the time, then only so obviously you cannot basically assume that every time you think a particular stock is undervalued or overvalued, it will perform according to how you are saying, right? Since we are active investors, we can be wrong many times, so you need to manage the sort of risk. Why would anyone spend time and money researching companies and estimating the intrinsic value of the stocks when all they have to do is check their market price? So here's the paradox. If the analyst believes that the market is mispricing a stock today, why shouldn't it be the case that mispricing will continue to persist? Obviously, if a stock is undervalued today and I know it's undervalued, so that doesn't mean that tomorrow it will go back to its actual price. It can stay undervalued for even a period of 10 years, right? Who cares? Like why would you say that it won't be mispriced after tomorrow, right? So that is the paradox. For example, shares of ABC are worth $100 but are temporarily at $80. He should also be able to identify the upcoming information or change of perception that will convince other investors that traders to begin paying more for the stock. There must be an event that changes the market's mind about the value of ABC, right? So otherwise, if there's nothing convincing that is going to happen in the market, then why would you think that the stock price of ABC will change from 80 and become 100, right? Therefore, identifying a mispriced security and irrational valuation by the overall market is necessary but insufficient step in the fundamental analysis process. The final step is to anticipate the catalyst that will help the rest of the markets recognize the true value of the under and overvalued security. Right. But concluding that a stock is undervalued is not the same as concluding that it is overdue for a significant price correction. So instead of just assuming that a particular thing will change its price, you need to have some sort of backing and you need to always be flexible and open that you can be wrong sometimes, and that is the reality and that is the truth of the market. Now let's talk about market efficiency, behavioral finance, and adaptive expectations. In this section, we'll consider three competing explanations of the way investors process information and incorporate it into their trading decisions and thus securities prices as well. The first explanation, the efficient market hypothesis. So this is one of the oldest theories, efficient market hypothesis. So we have discussed EMH in other videos as well, but let me just quickly tell you what EMH is. So efficient market hypothesis basically tells us that the price is discounted. When I say price is discounted, I mean that the price possesses all the information which is there with it. So every single information which we have even no idea about, everything is already known to the price, and the price already has shown the impact of all the sort of news which it has. So all the knowledge is always there with the price. Okay. So that is what they are basically saying. The second comes from the newer field of behavioral finance, which allows investor emotions to play a larger role in securities pricing. So this basically talks about, see, since we all are human beings, right? We all are thinking beings and we all are social beings. So obviously, what we think and what our mental state or our emotions say and what our psychology is basically saying, everything will be impacted in the stock price, and all of that basically have a great impact on the price of the stock. So that is the concept of behavioral finance. So we do have, our emotions do have a role to play in securities pricing. Behavioral finance recognizes the pricing errors that can not only exist but sometimes persist for long periods. The third explanation, the adaptive market hypothesis. So we saw efficient market hypothesis and we saw the behavioral finance. Now let's see what is AMH, which is the adaptive market hypothesis. Now, adaptive market hypothesis is new as compared to behavioral finance and as compared to EMH. So, the adaptive market hypothesis views the interactions among investors, securities, markets, and institutions as a dynamically evolving ecosystem. Okay, within the AMH frameworks, winners are determined by their ability to both compete and adapt to constantly changing circumstances. So the AMH, or the adaptive market hypothesis, they basically think that the people who are trading in the market, the investors, the big investors, FIIs, DIIs, retail investors, everyone, their way of investing, their way of trading is going to be evolving and updating and changing according to the time. So this is something which is said by the AMH, or the adaptive market hypothesis. So now these are the three things which you need to know keep in mind. The first thing is efficient market hypothesis. The second thing is behavioral finance, and then the third one is adaptive market hypothesis. Which one is the newest among the three? AMH is the newest among the three. Now, let's talk about market efficiency, right? Now, what is market efficiency? So, it is also known as efficient market hypothesis. No matter how much you have heard this theory praised or ridiculed in the previous coursework or via other exposure, it is important to understand that this theory says that active investors, anytime we're talking about beating the market, actively investing to earn risk adjusted returns that are higher than the returns of a benchmark index, we are talking about market efficiency, because we are asserting that we possess tradable information that the market does not fully understand or cannot accurately pass through a securities price for a reason. But you need to keep in mind that this particular theory says that all the knowledge and all the information is already known to the market. All the knowledge and all the information is already well known to the market. That's what the theory basically says. Understanding market efficiency is a useful step in understanding and exploiting deviations from efficiency. When information is not accurately reflected in a stock price, there may be an opportunity to buy or sell the mispriced security and earn excess returns. Based on the typical textbook treatment, one could get the idea that the market efficiency is a theoretically abstract concept that has no applications in the real world. Yet nothing could be further from the truth. Securities traders and finance professionals of all types are concerned with the issue of market efficiency. They just employ a perspective. So basically, that is what this particular theory states. Okay. The academic perspective says a securities market is informationally efficient when the news is rapidly and accurately reflected in the prices. Although that's a perfectly accurate statement representing the usual treatment of this topic in finance textbooks. The practitioner's perspective, however, asks, are there any trading strategies based on historical or publicly available information? So for you, you might think that the company is releasing the news statement today, but you really don't know. The market discounts everything, the price discounts everything, which means that the price already knew that this sort of information will be coming into the market. Securities prices in an efficient market. The prices of stocks and other securities in an efficient market will react rapidly and accurately to news, where news is defined as information that is relevant to the value of the security and unanticipated by the market. The security prices are thought to reflect all information that is relevant with the valuation of the company. Markets are thought to be efficient due to the research conducted by rational wealth maximizing analysts. The large potential profits from making the right call motivate them basically to do their work well and so on. Now let's talk about the three levels of market efficiency. Now, what are the three levels of market efficiency? Market efficiency is often described as having three possible levels which define the type of amount of information assumed to be fully reflected in prices. This classification can be understood by inserting one of the three bullet points. Securities markets are dash efficient if gathering and analyzing dash information does not consistently produce excess events. So the first thing is weak form historical, semi form, and strong form. If you believe market prices fully reflect the historical information but not necessarily current, then you are classifying market as weak form efficient, right? So what is weak form? Weak form means that you think that you're not sure about it. In other words, all historical information are so well reflected in the market prices that it is always impossible to trade on that information to earn excess returns. If, however, you believe the market prices fully reflect both of the information, then you are classifying market as semi-strong efficient. In this case, you analyzing past and current information is not useful in consistently outperforming market. There's not much point talking, right? So we will focus on semi-strong level and assume that the investors are proficient in both technical analysis and fundamental analysis. So that is what we are assuming in this book. Now let's talk about the behavior of security prices in an efficient market. So our assumption here is that the market is efficient in nature. Now let's say that news is released regarding a large unexpected change in profit outlook of a firm. In an efficient market, we would expect to see the stock price react immediately upon the release of that information. So obviously in an efficient market, we assume that the moment the news is out, the prices immediately right there and then will show a particular reaction. Since the market is so competitive, only the investors who receive the news and immediately act on it will get excess returns. Everyone else will be obviously late, right? Because the movement after the news has already been shown. As the trades of the first investors cause the stock price to correct to the fair value. Figure depicts an efficient market reaction to news. So this is 34.8. So you can look at this. Okay, the stock was normally going up. It was just normally going up at a steady rate, not something. IBM stock declined 7.75%. So earnings were bad. So as soon as the earnings were bad, the price dropped till here. Now, my point is that if someone realized when the price is here that now they are shorting because they think the price will drop further, what will happen? A little bit it will go in their favor and the price starts to retrace again. So the people who reacted immediately, only they are able to earn the money and others are not. IBM's reaction is considered efficient due to the way the stock price behaves after the adjustment. Notice that after the 2 day price adjustment, IBM begins to trend again. So that's what you need to know. That's what efficient market analysis basically talks about. Now, do analysts dig deep enough? Figure shows Amazon stock price reaction to April 26 earning announcement. So let's look at 34.9. Amazon was consolidating and then stock went up because of some positive sort of announcement which happened. Now what does this say? The market was expecting Amazon to earn 7 cents a share, but the company has reported 28 cents. So that is basically four times the number, right? There was a large positive stock reaction, so which is why there was like nearly 18% up in the stock. Over the same days, S&P declined. So once again, the stock reaction was almost certainly due to the company specific information. Then what happened? Now we'll focus on Amazon stock returns following the through mid June. The stock lost 6.58. It is possible that overreacted to the news. So obviously, after a while, you can see that in June the price came down again. First reason is that S&P was not performing well, and second reason is that when the positive news happens, the market overreacts to it and goes really up, but actually that is somewhat overvalued. Thus far, it looks like the market was efficient around Amazon's earning announcement. There are actually several reasons to think that the market was not functioning with perfect accuracy and objectivity in this case. However, the first reason is that Amazon was on pace to report earnings, and obviously, after a while, it basically again went back. Now let's look at the fact. Amazon's first quarter earnings diverged significantly from the guidance provided by the company. Amazon offered no explanation for this large divergence. There were 17 analysts on earnings call, yet none of them asked why the earnings were larger. Amazon Investor Relations did not respond to the email. So these are few things which were extremely odd, right? These are things which shouldn't happen if everything is done ethically. So that was a question which was raised. Now, so after that, you can see how the operating margin also looked like. So that's the thing. The key question is whether Amazon stock price objectively reflects all relevant information or not, because this is quite some strange behavior. Okay. Now let's see some anomalies which the EMH cannot explain. While the efficient market hypothesis is a good starting point for understanding markets, researchers have documented numerous empirical facts about investing and markets that are inconsistent with the EMH. The existence of consistent patterns in securities price and price volatility implies tradable opportunities based on past and current information that would not exist in a highly efficient market. Now let's look at what the anomalies are. Correlations in security returns. Okay. Now, the first point is correlation in security returns. Individual security returns are negatively correlated on a daily basis, positively correlated over intermediate horizons, and negatively correlated long horizons. Consistent correlation pattern would not exist in highly efficient markets. So, this is the first point you need to keep in mind, that constantly nothing can be continuously have some sort of a correlation, right? It can either be negative or positive, but nothing is fixed. Mean reversion or a reversal effect in a security prices. So even if a stock is in a healthy uptrend, you know that these sort of corrections do happen, and even if a stock is in a healthy downtrend, there are some sort of corrections that's gonna occur. So these corrections are basically called as mean reversion, and usually even if the portfolio is performing really well, there are going to be mean reversion periods or there are going to be correction periods. Portfolios of stocks with the best records over the past 2 or 3 years subsequently underperform the market, and the portfolios of stocks with worst will basically outperform the market. Then we have underreaction to the news. So just like how we discussed overreaction to the news, in some cases the stock does not react as much as it had to react to the particular news. So there is a significant short-term drift in prices following both good and bad news. Then we have the size effect. Small stocks outperform large stocks by more than would be expected based on the higher volatility. So from 1931 to 75, the 50 smallest stock outperformed the 50 largest. Okay, so small cap do outperform the large cap stocks, but you also need to understand that when it comes to underperformance also, in that case is also small caps underperform much, which means they have a significant drop as compared to the large cap. Next, we have the PE ratio or the value stock effect or the price to earnings ratio. Studies show that the risk adjusted returns of the lowest PE stock portfolio are much as 7% per year larger than the risk adjusted returns of the high PE stock portfolios. Okay, so low PE stocks have a higher return as compared to a high PE stock. The January effect. Stocks of small cap companies experience unusually high returns in the first 2 weeks of January, then their returns revert to the average of rest of the year. So this is something which you need to extremely keep in mind. Okay, give me a second. I need to take a picture of the January effect. Okay. Patterns and volatility. Returns are more volatile. Returns, one second. Returns are more volatile during bear markets. Market volatility is greater at the open and the close than during the trading day, and overall market volatility is excessive. Okay, obviously, so opening time and the closing time, the volatility is high as compared to the middle period, because during the middle period, it is usually very silent. Okay, so most active hours are the opening and closing. For example, if you're trading Forex, you know that London session and the New York session, even the Frankfurt session. So these are the sessions where there is some sort of volatility, whereas in sessions like, um, you know, um, however, in sessions like mm, Asia, the liquidity is not that great, except for some Asian pairs. Like the also, if you see the Japanese yen pairs, they perform well in Asia. While the EMH remains the most studied theory of how information is reflected in securities prices and is a good entry point for understanding the extent to which prices accurately reflect relevant information, it is also clear that EMH is subject to market criticism. So, yes, of course, whenever a theory is discussed, there are people who like it, there are people who agree, and there are people who do not agree. And both of them have their own point of views, and both of them have their own valid reasons. Now let's come to behavioral finance. We've done a couple of chapters on behavioral finance. I'm sure that you do know what prospect theory is. We saw that, right? So their original prospect theory has evolved into what we now call behavioral finance, a theory of information, security prices, and investor behavior that competes with and frequently contradicts the high rational premises and predictions of the efficient market hypothesis. Behavioral finance maintains that investors suffer from cognitive biases or inefficiencies which with the way they process informations or like and draw conclusions. Some of the major biases include the use of heuristics. Now what is heuristics? Let me also highlight this so that you remember. Yeah, heuristics or mental shortcuts that make decision making easier. So these mental rules of thumb can lead to biased reasoning and suboptimal investment decisions. However, especially when circumstances are changing, because the old mental shortcuts are no longer appear applicable. So whenever you talk about heuristics, you need to know that they are talking about mental shortcuts. That is heuristics. Okay, now let's go to extrapolation errors. Now, what is extrapolation errors? Extrapolation errors occur when investors assume that current and recent conditions will prevail well into the future, also cause them to ignore evidence of changing circumstances. You can never assume that things are not changing and everything will stay just the same as how it is right now. That is not a nice way to think. So, when we are talking about extrapolation errors, extrapolation errors means that investors assume that current conditions will stay as it is even in the future. But what you need to know is that that is not true, because situations are changing, markets are changing, and we need to expect that everything will change as well. So, research by Barber and Odeon shows that people tend to be overconfident regarding their abilities, which leads to mistakes such as too little diversification and too much trading. Barber and Odeon find that men are more overconfident as compared to women and thus trade more, despite the fact that their performance of stock portfolios worsened as their tendency to trade is different. Let me also take a picture of this. Give me a second. Okay. Research by Barber and Odin shows that okay, men are overconfident as compared to women. Stateman and Norfinger 2010 and others have identified additional cognitive biases that often derail investors' thinking. Some of the most popular biases include hindsight error, which um, tricks people into thinking they can foretell the future because they can observe the past. So just because you know what has happened in the past and just because you expect that to happen in the future doesn't mean that you have some sort of magical powers that you know exactly what's going to happen. So you can never be very sure about what will happen in the future. So that is basically about the hindsight error. Confirmation errors. Errors occur when investors place too much weight on information that confirms the prior opinions. Cognitive consonance. So whatever prior before what opinion you had, you can't keep sticking to it forever. but underweight or complete disregard evidence that contradicts their prior opinion. So, cognitive dissonance. So, you need to know that something that has happened in the past, or some opinions you had in the past, they can change in the future. Whitney Tilson, managing director of T2 Partners Hedge Fund, cites additional biases that affect the behavior of value investor, including misunderstanding randomness, which involves seeing patterns where none exist. So, misunderstanding randomness is that you are just seeing random things and you are just assuming that that is a particular pattern when it clearly isn't. So, not always you have patterns. Okay. Vividness bias, which causes investors to overweight particularly memorable experiences, even though they might not be relevant. So you can't vividness bias, you can't give more importance to something just because you remember it too well. Okay, so quickly, what is heuristics? Heuristics means mental shortcuts. What is extrapolation error? Circumstances are changing, so you need to have some shortcuts which are new. Hindsight error, you cannot see the future. Confirmation errors, you can't give that much importance to something that happened before. Cognitive consonance means prior opinions. Cognitive dissonance means that sometimes it can change and you should be comfortable with it if you have enough of evidence. Misunderstanding randomness, being seeing patterns which actually do not exist. Vividness bias, giving some particular thing more importance when it really doesn't deserve it. A complete treatment of behavioral finance is beyond the scope of this book. Okay, now let's see more. Now let's okay, we talked about EMH, we also talked about the behavioral finance. Now let's see the new thing, which is the most latest form until now. It's called the AMH, which is adaptive market hypothesis. The adaptive market hypothesis views financial markets from a biological perspective. This theory of investor behavior asserts that the interactions among markets, institutions, securities, and investors result in an evolutionary type process that unfolds according to the laws of economic selection. The AMH allows for economic agents to adopt via the competitive interactions but does not require that the markets evolve toward optimal outcomes. This is the first major conflict between the AMH and EMH, which maintains the market outcomes are always optimal. The roots of the AMH concept of sociobiology apply principle, okay, emphasize the need for creative destruction in capitalism that creates bursts of entrepreneurial activity. One of the major proponents of the adaptive markets is preferable as a theory of investor behavior because it allows for the cognitive biases identified by behavioral finance, but it also recognizes the high level of prevailing in markets which continually adapt to change. So whenever you are talking about AMH, just look at the name. It talks about adaptive. So you need to keep in mind that adaptive procedure, and the people and the investors and the participants in the markets usually adapt with the and evolve with the changing time. AMH can explain how the market behavior that appears anomalous under the EMH can emerge, persist for a while, and then disappear. So that's about AMH. I hope you understood. Fine. Now that we've seen the three theories, now let's quickly summarize the three. In this section, we consider three competing explanations of how information becomes incorporated into security prices. The first was known as efficient market hypothesis, emphasizes a high degree of rationality in the market pricing mechanism. Second is the behavioral finance, expressly recognizes investors commit numerous cognitive errors, obviously, and these mistakes can affect the market prices. The third is the adaptive market hypothesis, which views markets as a complex evolutionary system in which investors are constantly evolving and adapting to both rational and irrational circumstances. Under the AMH, real world investors aren't concerned with being rational or irrational. They are trying to figure out what worked yesterday will work tomorrow or not. Now we've seen what we've seen so far. Now let's talk about additional perspectives on investing. So, this section of the chapter presents a variety of perspectives that will further inform our investment philosophy and guide our efforts to construct and manage a portfolio which will basically outperform the benchmark index, whatever the benchmark is. So let's talk about John Bogle, an index fund fundamentalist. Okay, so he had a index fund and he used to basically do fundamental analysis on it. Okay, John Bogle. So he's the founder of Vanguard Investment and is widely credited for the equity index fund. Bogle was invited to review and extend his work regarding the superiority of indexing by Journal of Portfolio Manager, one of the leading investment journals. Bogle shows that for almost all types of equity portfolios, um, passively managed index funds earn higher returns as compared to actively managed funds. So again, don't stick to this thing because that's what worked for John Bogle, right? So it doesn't mean that only passive funds are good and active funds are not good. You really don't know what works for you. It is a very individual kind of a thing, right? This finding holds for every category except small capitalization growth stock, implying that active managers were able to add value only for small cap, which required the most research to fully understand. Bogle also refutes a view regarding market efficiency. Miner makes a clever argument. If investors increasingly believe in market efficiency, then they will engage in more indexing and less investing. After a while, security prices will reflect the because of the lag. Bogle disagrees, arguing Miner does not take high costs of active investing. So, okay, that's what Bogle also said. Bogle basically was interested in passive sort of investing as compared to the active investing, and he also had his own firm, which was basically in the index fund. Okay, so Bogle was done. Now let's come to Charles Ellis, which is basically the levels of the game. Now, what did Charles say? Charles or Charlie Ellis is a legendary investment manager and an author of 16 books. In addition to managing a significant portion of the Yale endowment, he sits on the board of Vanguard Investments and serves as an associate editor. Now, like John Bogle, Ellis is a valuable source of well intentioned advice regarding investments and financial markets. So, what did he do? Basically, 89% of all actively managed US mutual funds have underperformed their benchmarks. Ellis attributes this underperformance to the increasing competitiveness of the active money management industry, which is dominated by highly educated, motivational um, people. So, Ellis pointed out earlier that over past decades, professionals have become the market. Well, over 90% of the volume is basically given by the professionals, with over 50% generated by the top 50 firms. This means that the pros are constantly buying and selling shares. Thus, a firm raises its rating. Okay, so again, whenever a firm has a rating which is given to the public or on their website, or nowadays it's even on the social media. Earlier it was just books and magazines. So because of that, what happened, you know, that a lot of the participants in the market are actually these people only, right? So that is one thing. Ellis also classifies investing activities into 5 levels. Okay. Level 1, asset mix. Determining the optimal proportion of equities, bonds, currencies, commodities, or cash to hold. Level 2, equity. So, first thing is asset mix, then we have equity mix. Normal policy of growth versus value stocks, large cap versus small cap stocks, and so on. So, we have asset mix, then we have equity mix, and then we have the active versus passive management. And then we have specific manager selection, which means that basically selecting which mutual fund you want, or like, and so on. And then we have the active portfolio management, which is deciding when to change portfolio strategy, and like, so on. Ellis's experience has led him to believe that keeping investors focused on level 1 helps them to avoid major mistakes. So that's about Charles Ellis. Okay, again we are talking about Charles Ellis. Is that his 2003 article, which was the winner game. So this also again gave like a really major contribution to the industry. The winners game, it is a partition life activities into two categories: winners games and losers games. In losers games, outcomes are most often determined by participant mistakes, like amateur tennis. In winners games, however, outcomes are usually determined by a decisive winning moves, as it is the case with high level professional sports. Ellie's point is that individuals are the amateurs in the game of investment, and one should focus on minimizing mistakes instead of, wanting to have like a high level thing. Additionally, why can't I move this? Yeah, okay. Ellie stresses that individuals need to remain aware that most of the cases they are disadvantaged, right? Because we retail traders do not have as much of tools and as much of high frequency information which these big firms happen. So you need to remain humble and you need to acknowledge the fact that you do not have that much of information how much those people have. The most valuable perspective Ellis brings to the active investing debate is that his belief that active investing triggers a higher error rate and that this is the most plausible explanation regarding why actively managed equity funds underperform their benchmarks so consistently. Most investors would benefit from giving more attention to the defenses and not losing. Ellis was also Ellis for advice regarding which mistakes to avoid. We are confirmation biased. We seek out and overweight the significance of data. We allow ourselves to use an initial idea or fact as a reference point. We distort our perceptions of our decisions almost always in our favor so that we believe we are better in making decision. We have a tendency to be overconfident. So these are the kind of mistakes which all of us make. Okay, so we also saw Charles. We also saw John. Right. Fine. Now let's come to Don and Sengmuller. So Don and Sengmuller is based on a paper which was known as Trading as Entertainment. The bottom line of the study is that investors who who dictated on surveys that enjoy investing and enjoy risk propositions. Entertainment appears to be straightforward explanation of why active traders trade much more than others and why underperform their peers, right? Because think about it, like a lot of people do it for fun. People don't really do it in like a serious note, right? So that is one thing. So you need to know: am I trading for strategic or tactical reasons, or simply to entertain myself? Now, these are the kind of questions which you need to ask yourself, right? What's your purpose? What's your reason to do what you're doing and why? Okay, so that is Don and Singular. And now let's come to John Maynard Keynes, chapter 23 of the General Theory. So, John Maynard Keynes gives a general theory of employment interest in money, is an inarguable classic in the economics literature. So, Keynes basically talks about his practical advice for investors, along with many keen observations about human nature. His genius and elegant writing style are full on display. Keynes' unique perspectives can be attributed to the many roles he undertook in his lifetime. He served as chancellor in addition to being recognized as the economist, he was also a currency speculator, which is now known as forex trading. Much of his advice stems from practical advisors. So Keynes basically talked about interest, money, and employment. So keep that in mind. Now let's talk about longer term expectations. Keynes begins with a thought experiment of how investors form their expectations regarding the future. Keynes writes that it would be foolish to put too much weight on matters that are highly uncertain. In particular, Keynes has noticed that humans have a habit of taking the current situation and extrapolating it into the future until they see definite evidence that they need to change. Keynes goes to write about the longer term thing. Keynes is particularly concerned with how the stock market allows for such a profound disconnection, something that relatively new in his day but we take for granted in 21st century. With this observation, Keynes anticipates another field of finance and economics known as agency theory. Okay, long term expectations and stock values. Keynes connects his ideas regarding how long term expectations are formed and the way modern financial markets allow for investment valuation to be determined by those who are far removed from the operations of the business. Thus, he notes stock value may often reflect it, relevant concerns and ideas, and not the close knowledge for the people actually running the companies. So, he basically goes criticizes the efficient market hypothesis. Keynes is working on the problems of asset bubbles and market crashes over half a century before the dot-com credit and all the real estate bubble and whatever happened. He was been working on all of them. Keynes says markets cannot be efficient. So this was the biggest contribution or the biggest paradox in the time because Keynes was such an important person and his statement made a lot of difference here. Keynes reinforces this point that market valuations cannot be correct most of the time because they result from a flawed expectations forming process conducted by people who are far removed from the businesses they are valuing. Keynes says that convictions persist because people like the appearance of stability and continuity in their daily lives. This makes people that, at least in short term, they are not exposed to excessive risk because stock values must be at least close to their fair value. Of course, Keynes believes that people are deluding themselves in this regard. Due to this gradual increase in the proportion, day to day fluctuations are ephemeral in nature. Okay. So that's about Keynes, and you need to keep in mind that Keynes was not very happy with efficient market hypothesis. Groundless expectations are the source of excessive volatility. One of the criticism of the EMH is that securities prices exhibit more volatility than it can be, justified. Keynes asserts that investors' groundless expectations are actually the reason. A conventional valuation that is established as the outcome of the mass psychology of a large number of ignorant individuals is liable for change. So volatility also happens because people have like very crazy expectations and then they are proved wrong. Okay, investment professionals and market efficiency. Keynes goes on to write that there is one viewpoint in particular that deserves our attention. We might suppose that competition among expert professionals who are supposed to have knowledge beyond that of the average private investors would correct the pricing mistakes. But that's not what really happens. You can read this if you want. How pros plays the game. Keynes further writes that professional investors is therefore forced to concern himself with the anticipation of impending changes. Okay, let me scan the rest. What's the page number? This is 559. So we have like six more pages. Let me save it. Okay, give me 2 seconds. You can just read this until then. Okay. Moving on, Keynes' point is that there is no such thing as liquidity for entire investment company. Whenever anyone wants to sell, there is no liquidity without dramatic price declines. From 2000 to 2007, there was a boom in the organization mortgage loans. So many of these loans were created simply because they could be bundled into complex financial investment. Everyone wanted to sell their securities during that time. So Keynes says that the game of investing might be called bait the gun. Investors, he knows, are more concerned with outwitting the crowd, right? Rather than actually, helping or like caring for them. Keynes' famous beauty contest analogy. This is probably Keynes' most memorable passage. He compares professional investing to newspaper competitions that were popular in the day, in which readers basically voted for the prettiest faces from hundreds of photographers. Depending on which face they voted for, readers' choice were placed into the jars, and a winning card was randomly selected from the jar containing the most votes. Keynes says that the stock market works like this game. Intelligent investors don't simply pick the stocks they think are the best, but the winning strategy instead involves anticipating which face will get the most votes. If your card is not in the right jar determined by popular opinion, then you cannot win in the context, right? Because now it's not an individual thing. You need to be in the direction of the majority people. It is not the case of choosing those faces which is one of the best judgment are really the prettiest, nor even the average opinion. You need to choose which you think that other people will have this particular opinion, right? The reduced role of fundamental investors. Next, Keynes anticipates and refutes the type of objections that market efficient market hypothesis raises. If the reader is motivated to interject that there must surely be large profits to be gained in the long run by a skilled individual who remains undistracted by the prevailing pastime and continues to purchase investments on the best genuine long-term expectations, he must be answered first of all that there are such serious-minded individuals and there is some sort of a difference which is there in the game and so on. So that is something you need to keep in mind. Investment based on genuine long term expectation is so difficult today that it is basically impractical. He who attempts it must surely lead more laborious days as compared to, and so on. Okay. Now, there is also a warning which was given by Keynes, right, to long term investors. He who most promotes the public interest who will in practice come under the greatest criticism wherever investment funds are managed by committees or boards or banks. So in this case you need to take some sort of risk management. Now, like I had mentioned earlier, that Keynes was extremely he really looked into the market bubbles, the real estate bubbles, and the 2008 crash and financial crisis and everything. Speculators may do little or no harm, that they are only bubbles on a steady stream of long-term investors, but they can be seriously harmful when long-term investors become the bubble on a whirlpool of speculators. When the capital development of the country becomes a byproduct of the activities of a casino, the job is likely to be ill done. And Keynes coins a term bubble that has remained in investors' lexicon ever since. So you need to know that this whole thing called as a bubble was initiated or was started by Keynes himself. Animal spirits. A large proportion of our positive activities depend on spontaneous optimism rather than rather than a mathematical expectation. Our decisions to do something positive are usually taken as a result of animal spirits. What is animal spirits? Animal spirits basically means that spontaneous, random decision rather than having some sort of like a proper, everything cannot be rational, right? End of the day, even we are just living beings and we are not AI or we are not robots. So obviously, spontaneous optimism does happen. Everything cannot be mathematically calculated since we are humans, right? So that is one thing which traders use a lot now, and even bubble is something which traders use a lot, and both of them were given by Keynes himself. So Keynes actually gave a significant type of contribution to the industry. That is one thing you need to keep in mind. Okay. Professional investment policy statements. We will wrap up this chapter by examining a professional investment policy statement and synthesizing the viewpoints from the chapter into simple IPS that summarizes the type of stocks we'll be looking for and the type of portfolio we'll construct. An IPS makes clear statements about an investor's or fund's objectives, return expectation, risk tolerance, time horizon, and so on. Highlights from the IPS from Morgan Stanley's Focus Growth Strategy team are presented below. You will notice similarities in the items mentioned in the paper and so on. Okay, let's look at the paper. Morgan Stanley's Focus Growth Strategy Profile. Now, what is the investment philosophy? Permitted market capitalization within the market capitalization of the benchmark index. Sector concentrations result from security selection, no specified minimum or maximum exposure to any sector. Security weight is 1 to 5%. Typical number of holdings is 20 to 30 securities. Invest in high quality. Investment team seeks companies with sustainable advantage, favored return, long-term capital, and so on. Stock selection is done by rigorous fundamental analysis, guiding principles. And whenever you are assessing the business, the team seeks to capitalize on the market inefficiencies. So whatever it can be, relative lack of coverage, which means that um, companies transitioning from one market capitalization to another, recapitalizations, and all of that comes under this. And then we have conventional valuation bias. What does conventional valuation bias means? That companies which have low PE ratio or price to earnings ratio are more attractive as compared to those with a high PE ratio. So low PE ratio are obviously more attractive. So that is one thing. And then we also have free cash flow generation and all of that. And then we have coverage bias. Experts typic Okay, so whenever you talk about conventional valuation bias, whenever the term valuation comes, you need to know that low PE is good for us. And what was the earlier one which we saw? We saw what was relative lack of coverage. So relative lack of coverage basically talks about recapitalization. Okay, that is relative lack of coverage. And then we have coverage bias. So experts use traditional valuation rules of thumb to assess companies in their coverage areas, rules that the team believes may be less appropriate in analyzing companies with new or unique business models that are generating. So coverage again, like we saw, what was recapitalizations, entering into new businesses. Short term bias, the team believes that it can exploit inefficiencies stemming from the fact that short term considerations. So obviously when you have stuff like quarterly earnings and everything, that also should be in your analysis and not just long term things. Now let's start with the investment process and check that out. The first thing is the idea generation. The team generates investment ideas through an ongoing set activities conducted individually and collaboratively. Involvement in contact networks across industries and in investment management business. Its reading network focus on ROIC and the free cash flow. Team discussions, identification of patterns, conventional valuation, checking the biases, and then doing the research. All of that you do. So when you do all of that, that everything comes under idea generation. And then we have bottom up analysis. You know what bottom up and top down analysis is. We have also discussed the difference between them, between both of them. The team narrows its idea generation by seeking stocks that reside in the intersection between whatever the company basically wants. And then we have disruptive change research. Now, what exactly is disruptive change research? To complement its in depth bottom up research, the team's disruptive change researcher investigates big ideas and emerging themes which have, like nanotech, infrastructure, and all of that. So, now these are the things which are disruptive in nature, right? Because now these basically we need like bigger ideas for this, so that portfolio construction and implementation. And then obviously portfolio is constructed, how many ever securities you want, how much you want to risk in one particular security. And then we have culture. The team's culture is shaped by four core values that are cultivated and reinforced in many ways: intellectual curiosity and flexibility, perspective of self-awareness, and partnership. Okay, look at this particular figure. So we have the investment thesis, we have quality of the business, what is the risk to reward, and the quality of the growth. So the business has to be good, and you need to not just the business. For the stock price to increase, you also need there is some sort of growth which we can see in the company. Okay, so this is a sample investment policy. You can see that how Morgan Stanley basically gave you the thing. So they gave the objectives, duties of the parties, who is the client, and they have seen how much you can risk and how much you can expect, and so on. What liquidity is, what is the time zone, what taxes you have to pay, what are the guidelines, and when will you sell it, and so on. Okay, so let's just quickly summarize a particular chapter. Active equity investors seek to outperform a market index by identifying individual stocks. Passive investors buy and hold. The fundamental analysis process is detailed and top down, starts with the overall economy, and then you see the business cycle, and then you identify sectors, and then you go and find stocks, and then you give the stock some sort of weights. Passive investors outperform the active investors. This is not a myth, it is a fact, but it is only in aggregate, right? So obviously majority, this is how the majority works, but there are a lot of active investors who do outperform the passive as well. So it's totally up to your personality and your discipline. Research suggests that two main factors contribute to the outperformance of the passive investors. So obviously there is no mental bias, and also there is no brokerage and other costs. Active investors need theory model, so they need something. Three main theories we saw: what was EMH, AMH, and behavioral finance. An investment policy statement. Okay, so this was the Morgan Stanley report which we saw. So that's it with this chapter.